So far, I provided you with a description of microfinance institution, as well as with some figures on the scope and division of this phenomenon. We will here deepen our understanding on the functioning of microfinance institutions by focusing on both the financial and non-financial products offered by such institutions. The objective here is for you to be able to identify and to understand the needs which these products meet. The book Portfolios of the Poor provides a result of the analysis of 250 poor households in Bangladesh, India and South Africa. Poor people obviously have very low incomes, but having read the text, you have learned that this doesn't mean that they do not have savings. Among the 250 households, even the poorest of the poor had some spare money, and thus a need for savings products. This is thus the first financial need, the need for a good savings product. If they have some spare money, most of the poor already save in one way or another. Some of them keep some cash at home, or save in kind, putting their money into various types of assets. The problem with these savings practices is that they may be insecure or not liquid, meaning that it's not easy to convert them into cash. Why do people save? For various reasons, obviously. For future social or religious events such as weddings or for the education of their children, and even sometimes for business use. Poor people even frequently pay a fee to save their money. The second financial product you may have thought about is credit. Imagine you have no access at all to credit. For a vast majority of us, whatever our current personal situation, it may be very difficult to finance some investment, a car, or even buying an apartment or a house. Without a mortgage loan, you can hardly buy a house. The poor have low incomes, but also frequently unstable or irregular income streams. Concretely, this means that they can have a few weeks or months without income if they are seasonal workers, for instance. Credit can be used for investment, consumption, liquidity management, etc. If you are a poor person, you will probably be financially excluded, and your loan application will not be accepted in traditional banks. Next to credit and savings, the third product I would like to highlight is insurance. Why insurance? The poorer you are, the more exposed you are to risk. As we've just said, the sources of income are unstable, irregular. On top of that, you are often confronted with many risks, and you have less wealth as a buffer to face these external factors. For instance, you may have an unforeseen health problem or live in an area affected by natural disasters. Then you will probably not have enough money to deal with this issue. Think about the fact that a large proportion of the poor live in rural areas and are farmers. Their main source of income therefore depends on the weather and sometimes international market prices for the product that they sell. Imagine therefore that you could insure against those risks related to health. According to a report published by the International Labour Office in 2014, more than 70% of the world population is not adequately covered by social protection. Moreover, in low-income countries, more than 90% of the population lack any affiliation to a health system or scheme. Saving, credit and insurance are the three most obvious answers. What else? You may have thought about money transfer or remittances. All of us may have some family living in another city or another country, and we may need to send them some money, sometimes urgently. We could spend hours on the need for financial services from a client's perspective. If you want to go further on this issue, I suggest you read the book Portfolios of the Poor, or another by Stuart Rutherford on his own, The Poor and Their Money. I will also provide you with reference from the ILO report on the webpage. Let's take now the opposite angle and look at the product from the perspective of the financial provider. It's not straightforward that a financial provider can collect savings or deposits. Regulators most often prohibit deposit collection if you are not regulated. We will see next week that one of the reasons why some organizations have started to transform into regulated institutions is precisely to be able to collect savings. Many microfinance institutions have used savings as a relatively cheap source of finance and a way to reduce their dependence on external financing. Collecting savings may thus be an opportunity. In a paper published in 2016, Anastasia Kozarenko, Aren Zafars and I identified the characteristic of microfinance institutions that collect savings. More precisely, voluntary savings. What did I say? Voluntary savings? Yes, because there are two types of savings. Savings can be voluntary when you yourself decide to save, or forced when it's a requirement of the bank, for instance to access credit. The main result is that the organizations who collect voluntary savings are frequently larger and more mature, but also less subsidized. Savings will thus somehow take the place of subsidy. What about credit? We know that banks usually do not lend to the poor because they lack collateral or guarantees, or because of the smaller size of their investment that makes the loans unprofitable. Some sociologists also raise the argument that banks or their employees are also simply not used to working with this clientele. Microcredit was therefore the revolution to overcome these obstacles. Microfinance changed a lot of things, and I believe we can say that microcredit was a disruptive innovation, changing the rules of the game. I would like to pinpoint two main innovations. First, new procedures were used, such as asking people to form groups and be jointly responsible when they form groups. This is what we call the joint liability principle. If one of the members of the group defaults, the other members have to pay for him or lose access to future loans. Thanks to joint liability, operating costs have been reduced so that it's less unprofitable or even profitable for the microfinance institution in some cases. Moreover, many microfinance institutions first offer very small loans to test the client and then slowly increase the loan size. This is what we call step lending. Step by step, they increase the loan. This is also an incentive for clients to remain clients and repay on time. Thanks to these procedures and probably other factors, microcredit repayment rates have been impressive, over 90% for good organizations. This is much more than most traditional banks in developing countries. The second innovation I would like to stress is more sociological or relational. To microcredit, the poor were considered as trustworthy clients. What a paradigm shift! To strengthen their relation with clients, loan officers delivering the credits frequently go to the field and meet the clients in their neighborhood. The fundamental opposition or mistrust between supply of money and potential clients is at least partly overcome. We should, however, not be naive. We still talk about credit and loans, and this must be reimbursed. Sometimes people have trouble reimbursing them, which has created a lot of tension among group members. One of the most debated issues in microfinance is related to interest rate charged by MFIs, partly due to the high transaction and operating cost of small loans. Interest rates often range from 20% to 40% per year according to environmental factors or the loan methodology. Tension has also emerged between clients and loan officers who see the quality of the portfolio decreasing due to late payments by the clients. When everything goes well, these frequent contacts create a clear win-win situation. Clients benefit from the support of loan officers have accurate and rapid information due to their ties with the clients. Nevertheless, when problems crop up, this proximity between loan officers and clients can turn bad and accentuate the tensions. In some cases, it led to accusation of unethical practices. As we have already seen earlier this week, individual loans are no longer exceptional in microfinance. In some cases, the emergence of individual loans is also explained by these tensions. As a final note, I would like to stress that microcredit shares some specificities, but the exact product design obviously differs between organizations. For instance, the sanctions in case of default vary. The location of the meeting of the group can also vary. It happens sometimes at the clients, sometimes in a branch of the MFI.